Most small business audits are self-inflicted. The IRS does not need your tax return to see if they can smell a problem. The IRS knows your industry better than you think. Most audit starts with a computer with no human involvement whatsoever. If your business looks normal to you on paper but abnormal on the paper, you can already smell the problem coming. And this is why my CPA told me this does not hurt. If you follow these steps and listen to this video till the end, your chances of getting audited by the IRS will dramatically go down. In other words, you're more likely not to get a letter and a correspondence from the IRS or a random selection because what you put on your tax return was not in line with what the IRS was expecting from the kind of business you operate. Hi, my name is Dhiren. I'm a co-founder of D2 Tax. In this video, I'm going to cover top 5 reasons why most business owners get audited and how you can avoid that from get-go. Every year, small business owners live in fear of the IRS. The very IRS that was given the responsibility to collect taxes from citizens, corporations, and taxpayers in general. Now we sit here and stay in fear of them coming after us for the money that we earned. And all of this happens because we lack the knowledge that we need as taxpayers. We lack the understanding of how certain categories of tax returns can unintentionally trigger more examinations, more taxes and penalties, all while you're trying to do everything right. You just did not know something. So let me get this fixed and let me show you what to watch out for. But before I get into these 5 reasons, let me tell you something that most people don't understand. Your tax professional is not going to be on the hook for any of the questions they ask you and you answer them in an email. And once they take those numbers under consideration, they put that into tax return. Now, if these numbers are wrong and you made a mistake, your tax professional is not going to be on the hook. It's going to be you and only you, because those emails that you sent him, they are a proof to the IRS from your tax professional that he did his part right and you, the taxpayer, provided those information to him. So you and only you are on the hook. He is completely off the hook and there is no other liability on him. Let me say this again. When the IRS comes back asking for a question, your tax preparer is going to show them the emails where you told them what to put on the tax return. And then the IRS is coming after you and not the preparer. So you can't just blame your accountant. You can't say, well, they should have known better. It's your responsibility to know what you are claiming and whether it is legitimate. If wealthy individuals paid taxes the same way you are paying today, they would not be wealthy the way they are right now. They understand something most people don't understand. They understand their biggest expense is taxes, but they don't just sit around and complain about it. Instead, they have full-time tax strategists working continuously, looking at their income from every angle. They have a 3-dimension view of their income they would be producing in the progressing year, which is the current year. And before the year ends, they already have their income and profits from dozens of different sources accounted for and fully deducted, which means on paper they show very little to no profit left to be taxed. And that is how their net worth increases 3, 4, 5 times year over year, because instead of giving that money away, they reinvest the taxable amount back into the system that generates even more cash flow year over year. Hi, my name is Dhiren, and this is exactly how the tax code was designed to work. Now let me ask you something. Would you play a game without knowing what the rules are? Would you go out on a basketball court and just start throwing the ball around without knowing what a foul is, what a travel is, and what the boundaries are? Of course not. You're gonna look like a fool. When you're teaching a kid to play a sport, any sport, what's the first thing you do? You teach them the rules. You show them the boundaries. You explain what they can do and what they cannot do. Without that, they have no chance of being successful at that game. So why do taxpayers put number on their tax return without knowing the rules? That's what most people do. They hear about a deduction and they think, oh well, I'll just write this off. They don't know the boundaries. They don't know the parameters, and they don't know what the IRS considers fair play. And then they are shocked when the IRS shows up asking questions. Here's what you need to understand. When you put a number on a tax return, you're playing a game, and the IRS knows all the rules. They have a whole system. It's called the DIF score that looks at your numbers and compares them to everyone else playing the same game. If your numbers don't match up with what they are expecting, you get flagged. That's it. That is how the game works. Most taxpayers don't know this. They just put numbers down, hoping for the best. And that's how you invite the IRS for questions that you're not prepared for. So let me teach you the rules, because if you're going to play this game, you better know what you're doing. The number 1 reason small business owners get audited is because of travel and meal deductions. Here's what happens. You work hard, you take clients out for dinner, you travel for business, and you think I can write all this off, but you don't know the rules. So you start writing off every meal you eat during the work. You write off family vacations because you thought you work for 5 minutes on the beach, and you send an email to your tax preparer to put $30,000 under travel and meal deduction, and they do it, and they're off the hook. And now you are responsible if the IRS comes back. The IRS sees this, and this computer system calls the DIF score flags your return. Why? Because your travel and meal expenses didn't match what other people in your industry are claiming. If you are making $100,000 but claiming $30,000 in travel, meals, and deductions, that does not make sense. It's out of the boundary. And this is where people goes wrong. The IRS isn't just looking at travel and meals. They're using those high expenses as a clue that you might have other problems on your return. Unreported income, personal expenses, being writing off as business, made up deductions, you name it. So when they see high travel and meals, they dig deeper. And that's how you end up with the audit letter and questions you cannot answer. The rules you need to know is meals are only deductible if they are directly related to the business. That means you are meeting a client, a vendor, or a business partner. You are traveling overnight for work. Your daily lunch because you were working is not deductible. That's personal. You have to eat whether you work or not. Traveling has to be overnight and away from your tax home, the place where you normally do your business. Driving across the town for a meeting, that is not travel, that's commuting. So how do you avoid this? Only write off meals that are actually for business. Client meetings, business travels, keep a receipt and a note about who you met and why. Write it on the back of a receipt and send yourself an email right away. Document it when it happens, not 6 months later when the IRS is asking. The key is document, document, document. The more proof you have, the more backing you have for the claims that you're making. And keep your expenses realistic. If everyone in your industry is spending about 10% of their income on travel, don't spend 30%. That's a red flag. And that is how you get flagged and invite questions you're not ready for. And remember, your tax preparer is just putting the numbers down that you are telling them to. If the IRS comes back, they are off the hook because they asked you the question and you provided the answer. It is not their fault if the IRS comes back with questions that now you cannot answer. The second reason is home office deduction. Everyone thinks I work from home so I can write off part of my house. But they don't know the rules, they don't know the boundaries. The IRS says your home office has to be used only for business, not mostly, not usually, only. This is a hard boundary. If you cross it, you are out. The deduction doesn't count at that point. Let me give you a personal example. I've been operating my business from home for quite some time. I have my entire upstairs set up as a studio where I record these videos, and my wife works from here too. This entire place is office used exclusively for business. But then we have kids. When we are both busy working, the kids are going to come, hang out, play with their toys, and sometimes sit over here and do their homework. And we help them with it. Now, if you go by the rules, it's not being exclusively used for business. And the thing about rule is this. Eventually, you're going to tell on your own self and reveal all the deductions you have taken. And at that time, you're going to regret those choices and deductions because penalties and interest alone will destroy you. I have seen this happen, and trust me, you do not want to go that route. Another reason I don't take home office deduction is because I also have an office, which is not where I live. And we use the expenses of that office to claim the office as deduction. Now, I can't tell the IRS that I am so hardworking that I have two offices, one at home and one as an actual office. It's not going to add up. Now, if the IRS comes to me and asks which one is the actual office that you're using, I may not be able to answer that question to them, and I may lose all the deductions. So I only deduct the actual office that I have.